All right, so I think we will go ahead and get started. I was telling Emily with the mute on how terrible my lunch was today, but she did not seem to care. But anyway, thank you guys for joining. My name is Mark Lamonica. I look after the individual investor team for Morningstar here in Australia. Today, we're going to talk about, at a high level, how to evaluate investments. So we won't get we will not get into anything detailed like a cash flow or discounted cash flow model or anything like that. We're just going to talk about some different things you can look at. But first, we need to go through our housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you would like a copy of our FAP, you can go onto our website, morningstar.com.au, to get that. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. But what I would like is questions, because questions make this more exciting for me. And as Emily knows, it's all about me, right? So you can follow us on Instagram. Of course, you can listen to our podcast. Also, as I keep talking about, our conference is coming up. So we actually released our first tickets to our wait list today. If you'd like to join our wait list, go join our wait list. Thursday, the 13th of October, 2022 in Sydney. Also will be streamed online as well. And you can, if you are on our wait list, we'll send you our agenda. So we've got a great agenda that Shawnee put together. But anyway, enough flogging of the conference. All right, we're gonna talk about how to evaluate an investment. So before we get started, and everyone obviously dives into the details on these things about which share or ETF or anything else that I should buy. But the most important thing, of course, is you. So this needs to be about you. Remember, any investment product, whether that is a fund or ETF or individual share, all of that is not your goal. Your goal, of course, is to reach your financial goals. So these are just tools to get you there, a means to an end. So yeah, we got to start with you. And our goal as investors is to select investments that will give us the return we need in order to achieve our goal, and also make sure that we stay invested. And I think that's an underappreciated part of investing. One of the key tenets to being a successful investor is being a long-term investor and sticking with it. We know that chasing performance, we know that trading a lot does not work. So yeah, the key is to focus on getting something that you are comfortable with, an investment strategy that you are comfortable with, that you will stick with over the long term. So we're not going to go through any of this stuff today, but once again, before you start evaluating an investment, whether it's something your mate told you about at the barbecue, or whether it's something you read about in the paper, before you can evaluate any investment, you got to start by understanding what you're trying to accomplish, the return you need to achieve your goal, the asset allocation you're trying to achieve. And that foundation will give you the ability to properly go in there and evaluate if an investment is right or wrong for you. And remember that something could be right for Emily that's not right for me. So that's why it's a little challenging going out there and hearing about investments and hearing and reading about investments in general without understanding what we're trying to achieve. All right, so we're going to start with asset allocation. And asset allocation is probably underappreciated in terms of the influence it can have on your ability to achieve your goals. So at a very high level, when we're looking at overall portfolios, we're looking at two different things, right? We're looking at expected returns and we're looking at expected volatility. So the expected returns are what can we expect to achieve over the long term as investors. Expected volatility is how much will that portfolio bounce around in value over time. So in general, this is very much a generalization. If you have a long time to your goal, you are probably, or you should be, primarily concerned with those expected returns. Because if I'm retiring in 20 years, why do I care if my portfolio bounces around? Now, you might care because that's going to induce you to do something stupid, but in reality, you shouldn't care, right? You should care how much money you have, where your portfolio is in 20 years, not where it is in 1 year. So in general, you should be concerned with the expected return if you have a long time to your goal. If you are approaching your goal, you might be more interested in volatility because, of course, the the amount that your portfolio could bounce around in the future is going to impact if you can achieve your goal, if your goal is occurring in 3 months, right? If you're trying to buy a house in 3 months and you've got all the money invested in the share market, well, you're not going to buy that house if, of course, the share market drops significantly. So something to think about. So what I did, just to show this relationship between return and risk, so right, the more volatility we take on, the higher that expected return should be, and vice versa, right? The lower the volatility, the lower that future expected return should be. I looked at the asset classes that make up our strategic asset allocation on Morningstar Investor. And what I did is, as a proxy, I found an ETF that is a passive representation of that asset class. So what I want to show, going back over the last 10 years, and remember, anything can happen in the future, but going back over the last 10 years, show this relationship between return and volatility. All right, so in some cases, I couldn't find an ETF, a passive ETF that had been around for 10 years. So I've noted those. All right, so what can we see here? So let me go through one example. I'll go through Aussie equity. So Vanguard Australia shares, one of the most popular ETFs here in Australia. So the last 10 years, averaged just south of 9.3% annual return. And then we've got this measure over here that maybe people are not as familiar with, standard deviation. So standard deviation refers to the dispersion of the different returns that we saw versus the average. So the higher the standard deviation is, the more volatile an asset class is or an investment is. All right. So very quickly, when we sit here and we look at 10-year standard deviation, 9.29% was the return. Then we look at the dispersion around the turn. We can say that in one standard deviation, so that's around, what is it, 67% of the time, I believe. 67% of the time, this ETF should return within one standard deviation, plus or minus, of the average return. So that means you can add 13.66 to 9.29. That should be the upside. Subtract it for the downsides. Downside is obviously negative. Then two standard deviations, now we're getting up to the 90% confidence level and above, right? So that means two standard deviations, I'm adding, 27.32 to each one of these, to the return on the plus side, and subtracting in the bottom side. So that means most of the time, 95% of the time, it should be within those two standard deviations. So that's how we can think about return and risk. So you can go through and you can see how different asset classes perform. So this IVV, that's actually the S&P 500. So I know it says international equity, but US makes up a lot of it. Has done very well, and I want to put that out there. So yeah, that's obviously a incredible return for the past 10 years. But anyway, that's what we're thinking about. So generally, as we're balancing portfolios, we need to think about, okay, for growth assets, which is basically global infrastructure and up, for growth assets, do we have enough allocated to growth assets to hit the return objectives that we need to achieve our goal? That's why we calculate what those are. But we know there's a lot of volatility. Whereas we start looking at defensive assets, fixed interest, and then cash, then we can see significantly lower returns, but a lot less volatility, right? So that's the trade-off. So the first thing we're trying to do when we're evaluating investment is to see how it fits into your asset allocation, which should be designed to achieve a return that will let you meet your goal. So that's the first thing we want to do. All right, then we can start getting into, all right, what are our other goals as investors? What's our investment strategy, right? And this can be very important. And there's all sorts of different investment strategies you can take. And this is where we're getting back to, let's come up with something that you individually are comfortable with and something that you believe in. Because if you're comfortable with something and you believe in it, it's more likely that you are actually going to stick with it over the long term. So there could be a whole heap of different things that you're trying to achieve as an investor. I put a couple examples on here, and we won't go through too much detail on all of these, but some people are looking to generate income out of their portfolio. All right. So once they've set their asset allocation, it's still important. Then you can start thinking about, okay, I want to generate income. We can talk about how you can evaluate different shares in order to achieve that goal. Sometimes you want to lower the volatility within an asset class. All right. So what we're talking about here is that, yes, those high level asset classes certainly have volatility, expected volatility associated with them. But within that asset class, you can also lower volatility if that's something you're interested in. So one easy way to do it, easy is the wrong word, is generally dividend paying shares bounce around in price less than non-dividend paying shares. Larger shares bounce around in price less than smaller shares. So those are opportunities where even within that asset allocation bucket, that Aussie equity bucket or that international bucket, we can lower volatility. Now, why do we want to do that? Well, why do we want to reduce the business risk of the companies we're invested in? Maybe because you're more comfortable doing that. Personally, that's what I'm more comfortable doing. So that's the way I invest. But other people want to get out there and buy small cap, no earnings growth shares because they think one of those will, quote unquote, go to the moon. Well, that can be your investment approach, but just make sure you understand what it is, because then we can evaluate investments within that, within those set parameters, right? So if you are a small cap, so small company growth investor, so companies where expected cash flows are way out in the future, generally trading at high multiples, high valuation levels. If that's your approach, then automatically, if somebody said, hey, I hear CBA is a great investment, you would automatically reject that, right? It does not adhere to your strategy. Whereas my standpoint, because I'm, some old conservative guy, like everyone seems to describe my investing style as, in my case, I only buy companies that pay dividends. So if somebody pitched to me this small cap growth company, and it could be a great company, and maybe it will turn into the next big company later on, it's not something I would buy. So automatically, that's not something that sort of fits in with the approach I want to take. And then obviously you can invest according to your value. So what we're talking about here is ESG, or at least whatever derivation of, anyway, I won't get on my ESG soapbox, but investing according to your values is also an approach that you can take. So remember, first thing we're doing is we're looking at asset allocation. We're saying, does this fit into a portfolio that's been designed to achieve my goals? Then we're starting to say, okay, what's my investment strategy? How are we finding something that I'm comfortable with and stick with for the long term? All right, so I just went through an example for generating income. So yeah, lots of investors like to, of course, generate income from their portfolio, because what's better than that, right? You get paid not to work. Passive income is a good thing. So what are some of the things that you're going to do when you're assessing investments? If this is your goal, my goal is to generate income for my portfolio. Well, the first thing you're going to go through and look at is you're going to look at the current dividend income versus the sustainability of that income and growth. So in many ways, investing, like literally everything else in life, is a trade-off between different things, right? And when you're investing for income, it's often a trade-off between high dividend yields, so where can I get the most income today, with how sustainable is that dividend, how much can it grow? So what are some of the things we want to look at? We want to look at the dividend yield, right? So the dividend yield is simply the dividend that has been paid out historically and comparing that to the price. All right. So the higher that yield, the higher you're going to earn in income per dollar you put into investment, right? So if I'm putting $1 into an investment, it's a 5% yield, then okay, well, I'm getting 5 cents. So 1% yield, I'm getting 1 cent, right? So obviously a higher dividend yield equals more money right now. We can also look at dividend growth over time, because remember, a dividend, two different factors need to be met for a company to pay a dividend, continue paying dividends. First thing is they have to be capable of doing it. They've got to make some money to give some money back to you. They need to be financially strong enough to do that. And then there's a willingness, right? Because a dividend is a choice. Some companies are really interested in paying dividends, some companies aren't. So looking back on dividend growth can kind of give you the willingness aspect of a thing. All right. So the other big thing that we're looking at when we're trying to make this trade-off is the payout rate. So the payout rate simply refers to, of every dollar of earnings that a company makes, how much is paid out in dividends, right? So it's an important number, and it can show you a couple different things. Number one, it can show you if there's room for growth. It can also show you if things are sustainable. So we'll talk about both of these. I pay out less of my earnings. That means, number one, without even earning more money, I could grow the dividend if I wanted. I could just decide to pay out more. On the flip side, it means that if my earnings go down, I might not have to cut my dividend because I can keep paying out the same amount. Because if I'm paying out 50% of my earnings and they drop by 10%, that's fine. If I'm paying out 99% of my earnings and they drop by 10%, now we've got a problem. Something to think about with payout ratio. One announcement, Will has sent a note saying, one announcement is we have been a little bit behind on getting all the webinars up on YouTube, but they're all up now. So all the past ones are up. Thought somebody had a question, but it's just Will sending a note from the other room. All right. The other thing, of course, we're worried about when we're looking at growth is, of course, companies have to generate earnings and cash flow in order to pay out dividends. So if I'm looking for a growing dividend, I need to figure out, is this company going to continue to generate those into the future and hopefully grow those earnings and cash flows in the future as well. So a couple of things you can look at. You can look at certainly our moat rating, right? So our moat rating is assessing if a company has a competitive advantage and how sustainable it is. Companies with competitive advantages should be able to continue to grow earnings over time as they invest more in the business. We can look at sort of projected and past as an indication of what the future might hold, earnings and cash flow growth. So that's a couple good things to look at if we want to see if the dividend will grow over time. And then, of course, we need to look at the financials of the company, right? So just like your deadbeat friend is probably not going to pay you back because they don't have any money. Well, a deadbeat company that owes money all over town could have a problem paying back dividends. So something to look at. The other thing that we need to look at as investors, if income is our goals, we have to assess the best vehicle to earn income. So we talked about individual shares. So of course there we're worried about the company's ability to pay out that dividend, their ability to grow that dividend in the future. So that's one side. But then many people turn to collectively managed investment vehicles to generate income. So whether it's an active or passive approach, getting somebody out, getting an ETF or getting a fund that's managed by somebody or a LIC, using those as vehicles to generate dividend growth. In that case, we need to be very cognizant of what those vehicles are and the rules behind them. So I say this a lot, but ETFs and funds are basically just pass-through structures. So that means any dividend income that comes into that portfolio and any capital gains that are generated by selling things in that portfolio get passed to you as the investor. Now, what this means is it means that distributions that come out of funds and ETFs are not dividends because they contain an income portion. They also contain a capital gains portion. That's number one. So what that means is that if there are a lot of capital gains, you could see a high distribution, which many people assume is a dividend and which many people assume will just continue in the future. But it's not true. Based on market conditions, you could get that, you could get a very big distribution. We've seen this a lot lately, especially last year. A LIC is a little bit different. So if you're invested in an ETF or fund, you should expect some volatility around the income that's getting paid, which can be a problem. So what does that mean? It means 1 year you might get $1. Next year you'll get 50 cents. If the market doesn't do well, then you can get $1.50. You can go back 50 cents. So that volatility in those amounts of income that are getting paid out in income and capital gains could really matter to you, depending upon your strategy. If you're someone sitting there trying to generate income off your portfolio to spend, then an ETF or fund might not be the right choice. Unless you have some way of smoothing out, there's consistency of the payments, unless you have some other source of income to smooth that out, that could be a challenge for you. LICs, on the other hand, for example, LICs don't have to pay out everything. So a LIC manager, a manager of a LIC could sit there and say, okay, we had a bunch of record special dividends this year. I'm just going to hold those back and I'll pay them out in the future year. And LICs can do this to smooth those income distributions that come out of them. And the reason they do this is because people like it for that just mentioned scenario where I'm living off my portfolio. People like a more smooth income stream. Oh dear. Oh, this slide, I forgot to delete number 2. Emily's looking at me very judgmentally, but let's talk about lowering the volatility within a portfolio. I don't know where the finished slide is. Well, I can just talk to it. All right. So the other thing that I think is underappreciated is that the business risk of different companies differs, right? So I talk about these examples all the time. A very small caps, a small company that has just started out, that maybe has one product, that's cash flow negative, that only operates in one market, like that's going to be a very different range of outcomes. The company could hit it rich, or it could go out of business. It's a very different range of outcomes than if you're an investor in CBA. CBA, maybe they'll grow market share a little bit. Maybe they won't. Maybe they'll overall their revenue go up a certain amount or a certain amount down, but they're probably not going to go out of business and they're probably not going to double in size in the next year, right? So that's an example where the range of outcomes are very different, meaning the business risk, the potential business risk that turns into volatility of those two investments is very, very different. So a couple of things you can look at are uncertainty rating. So the uncertainty rating is looking at how certain our analysts are in their predictions of the future cash flows that a company is going to generate. The more certain they are, so the low uncertainty ratings, means that once again, that range of outcomes is probably narrower. We can look at the cyclicality of the sector. We can look at the market capitalization. How big is the company? Big companies, less of a range of outcomes than really small companies. We can look at the income paid, because number one, that can be a signal that you have confidence in the company's future by paying out dividends. Also, just from an investor standpoint, a big dividend is a good reason to hold on, even if the share price isn't doing great. So we can see less volatility. So those are all factors, and there's more that we can look at as well in terms of quality, right? Financial strength of the company, pretty important. More debt a company has, the more it's at risk. Having one of those sort of wide ranging outcomes, like they could go out of business because they can't service their debt. So all stuff to think about. All right. And the last thing we're going to talk about is, in big buckets, how are you going to evaluate companies you're going to look at, or companies that are held within a fund or ETF? I will talk about some key metrics you can look at. First of all, you'd like to buy a great company. And everyone always talks about great companies, but how do we actually define that? Well, company is pretty simple, right? We're concerned with how much they sell. So that's top line growth, right? That's revenue that comes in. They're selling more widgets, they're selling more goods or services, et cetera. How much they actually sell. And then we're pretty concerned with these two measures right here. Number one, how much they keep. So a great company will keep more of every dollar in sales than a poor company, right? That means they're generating that income more efficiently. They're able to potentially control their prices more than other people can, right? We want to buy companies that are price makers, that they're determining what price they can charge because they have pricing power with you as a consumer. And that's especially important right now, given what's going on with inflation. The other thing, of course, we're really, really concerned with is what they earn on future investments into the company. Sorry. Geez, that's embarrassing. Emily's putting me to sleep. Yeah, we're very concerned about how much they're earning on what they're investing back in the company, right? A great company earns a really high return on what they invest in the company, right? So a great company can go out there and borrow money at 5%, invest it in the company at 10%. And what is that difference? Well, that's them actually generating profits for you as an investor, right? That difference over the time will keep compounding to you as an investor. So we're looking at the return on invested capital, return on capital that's invested in the company. And the reason that this is really important and what happens over time is that both of these measures, return on invested capital or return on equity, we like invested capital at Morningstar, but could also be return on equity, return on what's getting invested in that company, and the margin, so the difference between what you sell and what you get to keep, over time, both of these are generally eroded. And they're eroded because of capitalism, right? So capitalism is competition, right? And the competition is supposed to benefit you because you, of course, get better products or you get cheaper products as companies are all competing for your money. That's what capitalism, that's not good for a company, right? We don't want competition as companies. So we want to sit there and say, okay, we don't have to lower prices because people be willing to pay our prices. We don't have to go in there and invest a ton in like marketing and research and development and everything else, all those things that are going to come out as costs. We don't want to have to do that, right? We'd rather invent one product and then just sell that same product for the rest of the time. And obviously this is unrealistic, and be able to do it at a really high margin, being able to keep a lot of the sales. Now, this doesn't happen in the real world because if a company is growing sales really quickly, guess what? People want to compete with them. And how do you compete? They'll try to either undercut them on price or they'll try to introduce a better product. That could erode market share and that could slow sales if you don't have a moat. Investments. Companies are investing in better products or marketing. Well, that's not good either, right? All those activities lower margins. And the less market share a company can capture of overall sales and the less profit they earn on the sales, the lower the returns will be on anything they're investing in the company. So all this kind of fits together. So the reason a moat's so important is because of competition and capitalism. That's why we want a moat. And moats you can actually measure. So when we're looking to evaluate investments and we're trying to find a great business, well, yes, it is understanding the economy and it is understanding that specific industry and sector and the different competitive pressures and who they're competing with. You can actually see a moat work, and you can see it work because you look for companies with higher returns on invested capital, and you look for companies that have higher margin. I won't go through these because we literally went through these the other day, but there are 5 different sources of moats. People have questions, ask away. And this is how we can actually see it. So what we did is we went back and we looked at return on invested capital and margin on different moat ratings. So Morningstar rates companies with 3 different moat ratings. So wide moat, we believe that sustainable competitive advantage can last for over 10 years. Narrow moat, not going to last as long. No moat, we don't believe they have a sustainable competitive advantage. So let's look at when we look at this. Return on invested capital. Works exactly the way we said it would. Wide moat companies have higher returns on invested capital. The narrow moats, and wide moats have more than none. And these are pretty giant differences. So if you're going out there and you're borrowing money at 5%, obviously making up this number, going out and borrowing money at 5% to invest in the business, you don't want to be here, right? Because you're earning a return that is lower than what you're actually paying in interest rates. Both of these are great places to be, not to see. There are two things we want to look at: margins, right? How much are they going to keep? And there's a couple different margins that we look at. Operating margin is just we're looking at what we would call the ongoing operations of the company, right? So how much are they selling? What does it cost for them to produce what they're selling? Net margin means we're looking at all margins. So that's truly the bottom line. Either way, in both these cases, you can see that wide and narrow moat companies significantly outperform the no moat companies. And at the end of the day, right, it is hard to sell something. So all that effort that's being put out by a company in order to do it, kind of want to keep as much as possible, right? So that's important. The other thing that we want to talk about today is relative valuation measures, because value is really important as well. What are you getting for the dollars that you're actually paying? Now, one confusion about relative valuation measures. Okay, good question by John. So John asked a question back on moats. All right, so John says, that means that startups such as Canva early on, or even maybe now, are uninvestable as they generally have no moats. Okay. I would agree that startups don't have moats, but what you're looking for is a startup. And remember, we're looking for always, as investors, is we are looking for the future. So basically what these measures that I just showed, like, I agree, right? So, this isn't as easy as going and finding these companies because everyone else has found them too. Really what we're looking for is the future. And what we're looking for is, okay, a small company like Canva could develop a moat into the future, right? And so what we're trying to identify in those cases, like any small cap companies we're buying, like any startups we're buying, trying to look pretty far out in the future. What you want is for Canva, in your example, John, to be one of these companies later on. And that's why we want to assess Canva's product. We want to assess against competitors. Like, will PowerPoint just introduce a new, I don't know what, slide design that can go on a social media that like wipes Canva out? Like, I don't have the answer to that, but that's really what you're evaluating when you're looking at a company called Canva. So just like we can sit there and we're going to talk about valuation measures. With valuation measures, of course, what does a lot of these startups make? Well, they make nothing, right? There is no price to earnings ratio because there is no earnings. But once again, what we're evaluating as an investor is we're trying to think, okay, what other valuation measure can I look at that will give me a clue that eventually this company will be profitable? But just make sure you remember that eventually that company needs to become profitable. No. There we go. Okay, so Craig has a good question. He goes, regarding earnings growth, more is better. Is there a guide as to what is good versus excellent, et cetera? So unfortunately not. So when we are looking at earnings growth, we need to look at it. Nothing is looked at in isolation. And we'll talk about this a little bit on the next slide, but nothing's looked at in isolation. So earnings growth is obviously a good thing, but you can still pay too much for it, right? You can pay too much for a growth share. That's why a company that's growing earnings quickly should always be trading at a higher valuation than one that's not growing earnings at all, right? Should always do that. But you have to sit there and say, okay, is that worth what I'm paying? What am I trying to accomplish with this share? So yeah, I would look at that, Craig. The other thing I would look at is sort of where they are in the life cycle of creating a company. You should always grow faster when you're a younger company. So if I sat there and said that, like, okay, well, if earnings growth, anything over 5% is really good, you'd look at me like you were crazy if you were a startup that had to grow 20, 30, 40, 50% a year in order to have the investments that were made in that company actually pan out. So yeah, I would just consider those factors, Craig. The problem with investing is there's no like set rule, right? That like, yes, more earnings growth is better than no earnings growth if it was in a vacuum. But of course, there are different valuation measures, different company sizes, etc. So John's saying Canva has crashed at the moment, which shows that they don't make anything really, but profit comes with competing from Adobe. In fact, it seems to me it's a very difficult startup to assess because it does not have an obvious moat, even in the future. So it's an exemplary petty company, make the money and know when to get out, perhaps. Yeah, I'm not going to make any comments on Canva. What I will say is, yes, we've seen a lot of these companies, these so-called like unicorn companies that have gotten these billion-dollar valuations that have never made money and have never come anywhere close to making money. Now, that does not mean they won't make money in the future and it'll pan out. But I think to get back to Craig's question as well about earnings growth is to make sure in those cases, it's not earnings growth, right? It's revenue growth. It's very important to look at the quality of that growth, right? Like, how sustainable is that going into the future, number one? And is that growth, are they just buying growth, right? Like, you got to be careful around that, right? So look at what is it costing them to acquire new customers, and does that make sense? All right. So like, a subscription to Morningstar Investor is $675, and we have a marketing budget. But if I ask people to fill a duffel bag with cash, I went out on the street and handed somebody $700 so that they would sign up for a subscription, well, our revenue would grow really quickly, right? We wouldn't make any money, and that's not really a good quality earnings, right? And so, yeah, I mean, I think Canva is an interesting one because you're starting to hear about all of these companies a lot more in the news, and especially Canva, as they've been, as a lot of super funds that have invested in Canva and other investors as well have been forced to sort of mark to market those investments and bring them down significantly, right? So with these private held companies, there is no price. I can't go on the ASX and look at where this thing is trading. Instead, what I'm doing is I'm going and I'm looking at what was the last transaction, what was the last capital raise that they did, which could have been a while ago, and then sort of how am I, quote unquote, valuing that company. So when they say Canva's worth $1 billion, yeah, maybe. But you need somebody to come out there and find that. You need another investor. It's not like this is trading on an active market. Do you have anything good to say about Canva? Not only does their share price crash, also just their application crashes if you use it. All right. So we're talking about relative valuation measures. So the very important thing, just like with Craig's question, the really important thing with relative valuation measures is that you are not valuing the company using them, right? You are looking at a metric which you can use to compare to other metrics, but it doesn't mean it's good or bad. And I think that's the really challenging thing. So like someone could ask me, what is a good price to earnings ratio and what is a bad price to earnings ratio? And once again, you can't answer that question without the context around the company, right? As investors, it is perfectly logical that we would pay more for a company that was growing faster. Question, once again, is how much more? So that's what we're trying to determine as investors. And that's why we can use these same relative valuation metrics to compare things to like the past, for example. Oh, so investors used to pay this much for a growth share. Now they're paying this much. Does that make sense? So that's something to look at. All right. So basically, I said all this stuff, rate levels, et cetera, et cetera, et cetera. All right, so those are all really important. And let's use an example for that. We've obviously heard a lot about interest rates lately, and part of the really high valuation levels we had in the market, they were justified by historically low interest rates, right? So now as interest rates go up, the market retreated a little bit. Now the market kind of thinks that they might be going down again next year. It's done a little bit better. But anyway, let's look at a couple relative valuation measures. So price to earnings, of course, is probably one of the more famous ones, the P/E ratio. We're simply looking at the price something's trading for. It's observable in the market versus their earnings, provided they have any. Remember, if you don't have earnings, you have no price to earnings ratio. This is a backward-looking measure, right? Because published earnings occurred in the past. So after a period ends, A couple months later, you get the earnings for it. Well, that still happened in the past. We don't care about the past as investors. We care about the future. Or using the past to inform the future. You can look at price to forward earnings. So you say, yeah, I don't care about the past. This company's going to grow really quickly. This company will double its revenue next year. So it's unfair to sit there or double its earnings next year. It's unfair to sit here and judge this company on its current PE ratio. We need to look forward a year. So that's another option you have. Price to sales. So if the company does not earn any money, if you're Canva, then we might look at something like price to sales. So, and remember, for all of these, we want to make like for like comparisons. So different sectors trade at different valuation levels, different types of shares trade at different valuation levels. So don't sit there and just compare the utility sector with the technology sector, right? They're very different companies. And not just because tech is more popular, but tech is a better business, right? It's more scalable than a utility, where I can't scale my utility that much without building another power plant. So something to think about there. All right. So what do we have right here? All right. So we've got 5-year price to sales, 5-year price to earnings of two companies, company A and company B. So company A in this case is trading at around 175% premium to company B in terms of earnings. What does that mean? It means 37 is a lot more than 13.4. What are these two companies? We've got Microsoft, and this is the data on this is a little bit old, but it gets the point across. We've got Microsoft, one of the world's great companies. We've got Kroger. That is a supermarket in the US. So if I just look at this in isolation, I would sit there and say, wow, company B is a lot cheaper. Maybe a lot of people would sit there and say, I should buy company B. But let's look at the other measures around these companies, right? So number one, Microsoft shockingly is projected to grow quicker than Kroger supermarket. So that's really important. Talked about return on invested capital. It's really important, right? Differences between the cost of capital and the return on invested capital accrue to us as investors. Oh, wow. This is a lot more. Not looking so cut and dry anymore. Net margin. Oh, geez. Microsoft, for every dollar that they sell, they get to keep almost 28% of it. So almost 28 cents on the dollar flow to the bottom line, flow to you as a shareholder. Like every supermarket, they keep very, very little. So all the work they do to go sell something for $1, they don't get to keep very much of it. So in this case, going back here, oh, maybe this is a lot cheaper. We should definitely buy it. I'm not so sure anymore. I don't think it's actually cheaper, right? We look at this, what is this? So 175% premium in terms of price to earnings. Well, what are the differences between these? It's a lot, right? So just something to think about. We're actually going to leave it there today, unless anyone has any questions. If you have questions, send them through. But couple important messages is that, once again, we need to have context to evaluate if an investment opportunity is right for us. It means we need to understand what we're trying to accomplish with our goal. We need to understand what is the asset allocation that allows us to accomplish that goal, and what is our investment strategy that we want to take. Then we can start figuring out, okay, what is the criteria to actually evaluate this investment on? Right. So I could invest very differently than Emily. That means if we're looking at the same share, she could say this is right for her, and I could say this is not right for me. And that's perfectly fine because we're taking a different approach. All right. So go to YouTube. They're up there. For all the people that emailed me asking for copies, I will get back to y'all tonight saying, here you go. Here's a link. And yeah, come to our conference. It'll be good. You can meet Emily. She's excited about it. She's flying back for Europe just for the conference, which she's really pumped about. But yeah, I'll be here. And I'll be at the conference. Shawnee will be at the conference. Anyone else that you know at Morningstar will be there. So please, yeah, please come to that. Oh, we have a question. All right, so we got a question. What is the difference between operating margin and net margin? Okay, so if we think about a company, so basically at the end of the day, a company is producing a good or service. That good or service, there is a variable cost associated with that good or service, right? So like if I'm Coca-Cola and I am making a bottle of Coke, that costs me a certain amount of money. I have to go out there and I have to pay for the bottle. I have to pay for the ingredients, mix a bunch of sugar with some water, and I have to put a label on that bottle, and I've got to ship it somewhere, right? So those are the variable costs. As I produce more Coke, those variable costs will actually go up. So when we're looking at operating margin, what we're looking at is and I have to pay people to produce that, right? Somebody's working in the factory. So when we're looking at operating margin, we're looking at, okay, of every sort of additional dollar of sales, depending upon how scalable a company, every additional dollar of sales, so I can grow revenue, this is how much I should make. Because all we're looking at is the price we're selling our goods for, and then we're looking the main purpose of our business. From Coke, it's making soda, looking at the revenue we're making from selling the soda, and we're taking out all the variable costs to create it. But then there's all these other costs that you have as a company. So, for one thing, you have to go out there and you have to pay interest expenses and you have to pay taxes, and you'll have corporate staff, right, that have nothing to do with making a bottle of Coke, but somebody working in legal and somebody, fending off the obesity lawsuits and whatnot. So you'll have all these different people that work for your company. You'll have buildings, you'll have a bunch of stuff that doesn't have to do with actually manufacturing your product. So you exclude all of that when you're looking at operating margin. So you'll hear a lot, like the term EBITDA, things like that we're not looking at margin there, but that's earnings before all this other stuff, earnings before interest, taxes, depreciation, amortization, et cetera. So that's operating margin. Now, when we're looking at net margin, we're just looking overall at the company. So at top line versus bottom line. So if we go back to this slide, where's the slide we talked about it? Yeah, if we go back to these slides, right, net margin's always going to be lower. So if this is Coke's case, all right, the wages, the bottle, the ingredients, everything else, I kept 21.1% of it. Then when I look at net margin, what's the rest I spent to run the company? All the non-direct costs associated with producing their goods. There you go, plus another 7%. So Rory says, can I have a copy of the slides? You can have a copy of the slides. Maybe I'll even find the right one and finish that one for you. But if you could send me an email at mark.lamonica1@morningstar.com, I will send along the slides. Anyway, thank you guys very much. Oh, Craig has another question. Are forecast earnings per share and dividend yield based on current share price? Well, dividend yield. Okay, so what we're looking at. So let me go to the website. Hold on. I'll sort of show you what we're doing here. Sorry, I'm just pulling this up and I will share. All right, so let's take there it is, valuation. So go into valuation. So, all right, so when I'm sitting there and I'm looking at price to earnings, right? So I'm looking at Combank right now. So we obviously can go back and look historically where it was, but current. So right now, what is CBA trading for? Price to earnings 19.29. All right. So that means the earnings that CBA made in the last reported periods, it's trading at a little over 19 times earnings. Then we have price to forward earnings. What does that mean? It means CBA is forecast to grow earnings because that price to forward earnings came down. So that's the current price, looking at what CBA is expected to earn in the next reporting periods going forward. So yeah, we're looking at current share price here when we're trying to divide those up. And so you can actually go on this tab, forecast. So forecast is what our analysts think is going to happen in the future. And these are our analysts. It's not a consensus view. It's literally from our analyst model. So you can sit here and say, okay, dividend paid for shares. So you see 298, 350. Those are actuals, right? That's that little a, actual, then expected, right? So Nathan, who covers CBA, expects their dividend to go up again, right? So that's when we start talking about forward. Okay, so Scott has a question. We're getting lots of questions now. Okay, so Scott has a question. Why do companies invest in low margin businesses and not high margin, which would drive margins higher? Yeah, I mean, listen, there's a lot of good reasons for that. I think number one, if you're talking about different companies, right? Like some industries are just going to have lower margins. So if we look at that food store example, right? Food stores have low margins. It's just the nature of the business. So, if you sit there and say, and I'm making up the numbers here, but like maybe 3% as a supermarket is an incredible margin, right? So we could sit there and let's say Woolies was at 3%. Once again, I'm making up these numbers. If Woolies was at 3% and Kohl's was at 2%, you could sit there and say, wow, Woolies is an incredible business. This is a lot better business than Kohl's. Look at how much more they're keeping of every dollar they sell. So in these high volume businesses, often you have lower margins. And that's just sort of the basis for companies, right? We all can't be Microsoft. And companies, of course, are going concerns. And, one of the things that's important to look at is, as a company, if I can earn my weighted average cost of capital. So when we're looking at return on invested capital, we want that higher than our cost of capital. But if I can go out and borrow for 5% and invest in my company and earn 5%, it's not great. I'll keep growing, but it's really not a great thing for a company, but I'll keep doing that because a company is, potentially hundreds of thousands of people working there. So a lot of responsibilities. Always hope that I can do better in the future. So companies are going to keep doing that, right? So that's why they will compete. And that's the thing. They will compete down to the point where their cost of capital equals what they earn on it to invest in the company. It's just kind of the nature of a company as a going concern that wants to keep going forward in the future. So yeah, it'd be nice, obviously, to look for high margin businesses. And why, as investors, would we might want to consider a low margin business? Well, because if we're paying too much for a high margin one, right? Like me sitting there and saying Microsoft is a better company than Kroger. Well, yeah, everybody knows that. That's why people are willing to pay so much more for Microsoft. So you're kind of looking at how things go relatively. All right, so we've got a question. How do you arrive at a PE growth ratio metric on a stock? Yeah, so you're looking at a PEG ratio, right? I assume. So all we're looking at then, what we're trying to do with P's, all these different things we're trying to do with P's, including the PEG ratio, which is what you're talking about, is we're trying to make people aware that companies that grow faster should, of course, be trading at a higher valuation measure, right? We don't want people getting into this mindset that all we should look at is the cheapest company and actually buy it. So all we're doing is we're looking at a certain time frame with PEG ratio. We're dividing that P. So let's say the P is 10. And if we're going back 10 years, we're looking at like a 10-year PEG ratio. We're seeing how fast earnings grew during that 10-year period. We're just dividing it by that, right? So that's all we're doing. So P ratio of 10, if it grew 5% in the last couple of years, we're just dividing those two things. So once again, we're trying to introduce that notion of growth being an important metric. Now remember, that's historic growth, like everything else. It's not future growth. So that's what we're looking at there. Oh, okay. So Craig is saying, peer analysis shows 2-year forecast PE and dividend yield for a range of stocks. My question is, what is the forecast share price? So there is no forecast share price. It's the current share price. As that current share price, that will change, right? So we can't forecast a share price into the future. So we're just looking at that current price. So hopefully that answered your question, Craig. All right, we'll try this one more time. Oh, another question. You talk about companies borrowing money, but how do small companies borrow money when they have no assets other than the business itself, i.e. no bricks and mortar that banks require? Okay, so, well, a couple different things. So I'm using borrowing money because borrowing money is a very simple way of doing this because we all get going to a bank. It's raising capital. You raise capital from different places, right? So your weighted average cost of capital is your total cost of capital. Part of that could be debt, and part of that is equity. Right? So how do small companies borrow money? Essentially, they give up their equity, right? So I start a business. I've started Canva. I probably would not be sitting here if I started Canva, but I started Canva. And maybe in the beginning, I went out and I begged my friends for some money. Now I've got this idea. Will you invest in my company? I might give up equity to them, right? So maybe I'm not going to pay them back. I'm going to say, well, you now own 10% of my company. Eventually, I'll get up there and I'll start to get into, VC funding, so venture capital funding. So I'm just giving up my company slowly over time. It used to all be mine, and now I'm giving up more and more of it to other people so that I can get money and grow it. So basically, that's how small companies deal with it. And there's all these different rounds of financing, whether it's angel investors in the beginning, then you get into more traditional venture capital. But every single time that I'm selling, that I'm raising money, that I'm getting money, it's like I'm a large company selling more shares. I'm just diluting my existing owners. And depending upon what they think about this, they could think it's a very good thing, because if they think if I just get more money that I invest in the business, I'll earn this great return and it'll grow more. So they could think that that's really great. But yeah, every single time I'm just giving up equity, giving up either my own equity or I'm giving up the equity of everyone else, right? So if CBA goes out there and issues more shares, they do a capital raising and they do it by issuing more shares, they are giving up your ownership of the company. They're diluting you. You will own less of that company. Now, whether that's a good or bad thing, of course, is what they do with that money. So owning less of a significantly bigger company is a good thing. Owning less of a company that doesn't grow at all with the money they raise is a bad thing. So hopefully that answered your question, Carrie. All right. Now we're going to try to end this because it is 2:00 and I have a meeting with Emily. All right. Well, thank you guys very much for joining. I appreciate it. We'll be back Thursday. Talk about something else.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.